Good afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to go ahead and take a look at the four major markets. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those markets, we'll move on and take a quick look at the U.S. dollar, see how oil, gold, and silver are doing, and then we'll look at any chart requests. If anyone in here has a chart request, feel free to type it into the chat, and I'll get to it as soon as we cover the markets. If you like what you see here, you can always follow me at StockDarts on Twitter, same name on YouTube, or you could visit us at patreon.com/StockDarts, where I post weekly blog content, including trade ideas and different interpretations of how to approach the market based off of what we see on these Wednesday webinars. Other than that, let's go ahead and get started. What we're going to do first is take a look at the S&P 500 through the ETF SPY. Alright, so here's a look at the S&P 500. We've had a good week. Nice 3-day bounce so far. This is what we kind of anticipated on Monday. Now, overall, the market is still not really doing much of anything over the last month or so. As you can see, we're just kind of stuck in a range. I'm going to go ahead and pull out the our rectangle over here. And you can see there was a pretty big change in character in the market that started on June 11th. We're kind of trending upwards and squeezing up towards resistance. We finally hit a major level of resistance. This was something that we were anticipating for a while, and I think it took a little longer than expected to finally find enough selling pressure to put a dent on the market's price action, but we finally got that. And since then, if you'll notice, we're ranging sideways, but we have a lot bigger candles. You'll notice a lot of the candles are pretty wide, especially compared to the candles that were preceding that area, right? You can see from the middle of May all the way up to the beginning of June, every candle was a little doji as we just slowly squeezed upwards and just kept kind of drifting higher. And then now we're starting to get much bigger candles back and forth as the market tries to find equilibrium, tries to figure out where it wants to go next. And at this point, I think we still haven't really figured it out. What we have found is that there is still persistent demand in the overall markets, and as you can see pretty clearly, every time we've dropped down to about the 200-pair moving average or the $300 price level on SPY, we found buyers. Even on the first or second day, we immediately started to try to bounce, and then when we gap lower the third day, we bounced again, and then we've kind of steadily drifted right back down to this area, but as you can see, we found support again this week. And so in the short term, we found a good support level here. I don't know that this level is going to hold over the next month or so, but right now in the short term, it has held again and has pushed the market back upwards as it tries to continue to push through and try to figure out whether the top of this range is going to be what breaks first or the bottom. But overall, despite the fact that it feels kind of bullish over the last couple of days, I think generally speaking, we could say that the market right now in the short term is in a pretty neutral time frame, as it's really just going back and forth between these two levels. Anytime we get close to the 310, 313, 314 area, we find a lot of selling pressure, and every time we go back down into around the 300 area, even if we just maybe push a little bit below it, we find a lot of buying. And so we're just going back and forth between them. I think when you look at the overall landscape of our economy right now and how we're beginning to close down again because of a surge in infections with the coronavirus, that there's a decent chance that we will eventually resume lower and maybe come down and start testing below these moving averages like the 200 and the 50. But for the moment, that's not the case. And at the moment, really, what we're doing is still kind of a bullish chart pattern. A lot of times when you have a trend that's going upwards, and that's really what started happening once we kind of bottomed out in March and April, you'll notice once the moving averages start moving upwards, the 20 and the 50, and they kind of go parallel towards each other, that's usually a sign of a pretty strong trend, which of course we had. And typically what happens in these scenarios is you come down and you test the 20, you bounce, and then if there's still a lot of selling pressure, you kind of come back and you go in between the 20 and the 50. And that's what we're doing right now. And more often than not, this actually resolves back to the upside. What you do is you come down, you test the 20, you test the 50, you come up, you test the 20, and then from there you either move your way back through it, or you come back and maybe test the 50 one more time before you break upwards. So if we're just looking at the chart pattern in a vacuum, it's actually still sort of bullish. But when you look at it with respect to what's going on around our economy, you can also say that this could be signs of a rolling back over down to the downside. You can see that the moving averages have flattened out, And at the moment, the 20 period is going straight sideways, the 200 is going straight sideways, and the 50 is starting to taper off, even though it's still inclining. So we're starting to get maybe a flattening of our momentum, and I think overall that's not anything to be worried about. I thought the move that we had from April to May to June was very strong. And the fact of the matter is that it's going to be very hard for the market to just keep chugging on forward into new highs without spending some time trading sideways. And I think at this point, we could probably say that we found the short-term ceiling for the price action, and now it's a matter of figuring out exactly where the floor for the price action is, and letting the market kind of wind off a little bit and get rid of some of this upwards momentum that it had. Find new buyers that believe in the market and aren't really in a spot to take profits. Because what's happening is that we have a lot of traders that can take profits here, and the longer we chug along sideways, the more they want to take their profits because they're worried it's going to roll right back over. What we need is new buyers to keep stepping in like they've been doing at 300, which will eventually support it for a move back higher if they can negate the extra supply and extra selling pressure that's up here. So for now, those of you that visit me on Patreon and follow our trade ideas, you'll know we were looking for long trades this week based off of what we look like a bouncing potential. Only one of those trades has really done well. The other two are still kind of stuck in neutral, but the market in general has done what we expected, which is for it to bounce. Now the question is, how much more do we have as far as upside is concerned? I would say it's pretty limited at the moment. Unless we see a strong move coming soon, we're likely going to find selling pressure here right around the 313, 314 area and likely stall out. And even if we do move past that level, we've got a gap here to fill around 318, which is going to be difficult to push through. So at the moment, we're kind of stuck in neutral. And for those of you that have taken some long trades, this is a spot where maybe you want to start looking at taking some profits, kind of reining in your risk a little and just being careful about where exactly you're looking for this market to sort of calm down. One thing I did point out, something that we've been mentioning for the last couple of weeks, this isn't a market that you want to be trading aggressively right now. This is a market where right now you want to be cautious. If you're someone that needs to trade actively, you're going to still trade, but you want to make sure that the trades you're taking are basically the ones that you consider your highest chance of success, and aren't gonna, you're not gonna just go ahead and take too many chances right now. I think at this point, you want to be cautious. You want to make sure that you're protecting your capital as you wait for better market conditions. I think the conditions we're in right now aren't really the greatest for. Oh, give me 1 second. All right, sorry about that. So we're at a spot right now where you don't want to get too crazy. You don't want to get too aggressive trading. You want to just make sure that you take what the market gives you, but you don't put yourself in a position where you become overly loaded to the long or the short side. At this point, you want to make sure that you're just kind of slowly trading back and forth and just letting the market give you what it wants and not really trying to take too much and just be patient and wait for a better chance to be aggressive. As you can see, anyone that's tried to go long or short over the last month really hasn't done a great job, right? Because we've just been going back and forth between a pretty tight range, about 10 points. And so unless you're timing these nicely by playing the edges of the range, you're not really getting much out of this. And I think that's going to be the case until we get a much clearer direction. And the direction at this point, I think it's pretty cloudy as to whether it's going to be up or down. I think that we're still at a spot here where it's very difficult to predict which way the market wants to go. A lot of the headwinds based off of news are hinting that the market wants to go down. But what the market is showing is that it doesn't really want to go down yet, because each time we come down to support levels, it bounces pretty quickly and pretty strongly. And for the most part, we've been ignoring a lot of the bad news, despite how bad the news is. And so, some of this, of course, is due to stimulus that underneath the surface is propping the market up, and that's not going to really stop it anytime soon. So that we're going to still have that persistent demand underneath the hood that's going to push the market upwards. And until we find enough selling pressure to overcome that, we're going to keep chopping back and forth. Okay. Now let's look at some key levels here. One of things I want to point out here is that 300, that 299, 300 level, it's actually a pretty important level long term. If we go back to the weekly chart and we take a look at where the S&P 500 is right now, you can see that there's 295, and then up here around 302, 303 is a very critical area, right? We back out a little bit more, and you'll see we spent, well, that was a little too much, but you'll see we spent a good portion, basically all of 2018 and most of 2019, trading sideways, mostly in a range between about 295 and about 255 or so. Last year, those of you that are regulars on Wednesday, I know you've seen this before, but it's always nice to go ahead and review this. Last year, we finally established some price action above that, and really that was kind of the price action that led to the big rally we had to close out the year and to start this year. Now, of course, with the surge of the coronavirus and the crash that we had, as we had to close down on most of our economy, we sliced right through that level, like just right through the top, right through the bottom, and kept going down. Eventually, we found support, and then what we've done for the most part this year is make our way right back through that range. And at the moment, the market is basically saying, you know what, we're really still at a better place right now than what we were in 2018 and 2019 as far as stock market prices are concerned. And so that's the key level that we keep holding above. Every time we found support is because the market is finding support at this area here, which, it's the old story about the markets, right? Resistance becomes support. And so we had all this resistance around 295 that held the market in check for a couple of years, and then now it's become support. And despite this one, this black swan event that sliced right through it, we've kind of come back, and at the moment we're still trying to establish that this is support. This is very critical, and it's an important area to really keep in mind. And if we start to lose this later on, then it might end up pushing the market even further down once we lose that level. Because again, once we lose 295, really the next level of support is all the way down in the 280s, and we might even make it all the way back down into the 270s. So that's really a key area that we want to watch, because it's a very important area of support, and once we lose that, the next level is quite a bit lower, and there's not going to be a lot of buyers that are going to step in with confidence until we hit that next level. So that's a key area to watch. That's part of the reason why we're finding support at this level. And until things change, we can just assume that that's going to be our next level of support. Now, a lot of times what happens is you test these areas 2 or 3 times before we break them, right? So we've had 1, 2 tests. So if we fall short of breaking past the range and we come down and test it the 3rd time, I think that's the one that's a little bit more critical, and that's the one we want to be careful and wait till support is confirmed before we want to go ahead and go long again. Of course, that's the kind of behavior you always want to have during these kinds of moves, but more than anything, you want to be even more careful with the next move down, because a lot of times that 3rd move is the one that fails, and that's what we're going to be watching. Now again, the moving averages going straight sideways, showing that the market still wants to trade sideways. Now if we lose 295 to 297, well then, like I said on the weekly chart, the next level down, we probably come down and fill this gap around 285 and find some temporary support. But really the next major level of support, and the level that I would say is going to hold, is 274. I still think this is a very important level. This was, for those of you that maybe don't remember, was where we were when the NBA decided to postpone its season, and basically most of the country followed suit and started closing their doors. And that became a pretty important area for us to kind of reclaim. And I think as long as we're holding above that, it shows that we're still in a better place than we were when we first started really closing down all our businesses back in March. So that is going to be a very critical level if for whatever reason we do start to see more selling pressure and head lower. And I suspect that that would be a very, very strong floor for price action, even if we start to get a lot more negative news. Because even if we start to close businesses now and reclose a lot of our economy, it's probably still going to be that we're in a better state than we were back in March 11th. So that should hold the support. Now, I'm not going to say go ahead and buy that. If we get 2 red candles right down to that level, then you still want to wait for buyers to step in before you go ahead and start buying at that level. But this will be more likely than not a good buy the dip opportunity if the market comes back to that level. Now again, that's an if. I'm not saying that it's going to get back to this level now. It may not, or it may. But that is one of the key areas you want to watch, and probably expect to find support with confidence. Other than that, we're at the level that we would find at support at confidence, which is again this 300 to 295 zone. Now to the upside, what happens if we keep rallying, right? What if we find more buying pressure here? and we start to make our way upwards. Well, I would say don't get excited about chasing long, because again, there's a lot of selling pressure here at 315, and I suspect there will be even more once we get back to this 318 to 320. 320 on the S&P 500 is a major level. Again, if you look at it, this is exactly where we started to drop after we started really getting news and figuring out just how serious the coronavirus was going to be. We had that one gap down, and then this is where things really started to get ugly, and we started to really just kind of crash. And to get back above that would be very important. It would be a big milestone for the Bulls. But I don't think that we're ready for that. I think at this point, especially with the news that we've gotten over the last couple of weeks, I think for us to get back above that level, we're going to have to start seeing things like our beaches and parks and bars start to reopen again and stay open, not what we've been doing now, which is starting to reclose them. So I think that that's going to be a very strong short-term ceiling for the S&P 500 and for SPY. And the very strong intermediate to long-term support level will be 273. So that leaves us with short-term support here at 297. And if we lose that, then maybe we come down and test 295 and try to hold before we come down and fill this gap. So those are the kind of the levels you want to watch if we break our range. If not, just keep trading this range, right? For those that took some long plays at the beginning of the week, you should be starting to look at scaling out as we approach this 312, 313 area. At that point, you could look at seeing if any shorts materialize, which you could take right back down to the bottom of the range, because it's very likely that even if we do kind of run past 315, we probably don't get past 318 to 320. So, another green candle or two, and we should have decent shorting opportunities. And then once we get right back to this level around 299, 300, we just go ahead and reset and do the other side of the trade again. And that's how you want to approach a market that's range bound. You don't want to chase long after we've had 3 green candles. You want to start looking at shorts. And once we get 2 or 3 red candles, you don't want to chase short. That's when you want to start looking at trading in the other direction. Okay? All right, let's look at the NASDAQ. This is going to be the one chart that's very different. As you can see, very close to all-time highs. It's still kind of trying to pull the other 3 indices along with it upwards. This is the one picture of the stock market that just doesn't jibe well with what we're seeing across the board. And of course, a lot of that has to do with the fact that a lot of the Qs is weighted in a very few stocks, and those few stocks have actually benefited from us staying at home, right? Amazon, Netflix, Google, and Facebook to a certain extent, although not quite as strong as say, Amazon. And some of the other smaller tech names that are still weighted pretty decently in the Qs have all done very well. And because of that, if there's an area of this market that has decided it's really ready to kind of push forward and move beyond the levels that we saw beginning of the year, it would be the Qs. Now again, I think this is still getting a little ahead of itself. I think at a certain point, and we're starting to see some headwinds now, Facebook and Google losing some ad revenue as companies decide to, where they want to start cutting their budget. And that might start trickling down in other places. I think Amazon at the moment seems to be pretty fairly well insulated, but if more people stay out of work and we have more businesses closing down, then it might lead to less revenue going through them, even if it's a high percentage of what our shopping is at the moment. So, I think at a certain point this is going to slow down, but for the moment, the price action is showing that this is the one area of the market that wants to keep trying to push upwards. 3 strong green candles now. Like I just said in the last on the last chart, at the moment you don't want to buy 3 green candles like this. This is not where you want to buy. This is where you want to start looking, maybe not necessarily shorting, because you want to short weaker areas of the market, not the strength. So you don't necessarily want to short the Qs, but this is where you want to start looking at taking some profits and, begin the process of trailing stops rather than trying to get aggressive to the long side. Because again, we're basically making our way right back to what was strong resistance and where we sold off the last time we came to that level. And as you can see, even though we keep kind of marching forward, every time we print a new high, we do quickly sell off, right? We had a new high, we sold off pretty quickly, then we made a new high and we sold off pretty quickly, and we're in the process of trying to establish a new high. And if we do so again, there's a decent chance that we sell off again. And this time, as I pointed out again on the last chart, you have the strong trend, but what happens is the more often you test that 20, the more likely eventually it's going to catch up. And it's, mathematically, moving average is always going to catch up to price and kind of eclipse it. That's just the way it is. The price is going to have to spend time above and below it. So there's a decent chance that we will lose the 20 at some point, and then we'll do that same test of the 50 that we just did on the S&P 500. Whether it's down here in the 230s and 240s, or whether it's going to be up in the 250s is up for debate at the moment. But sooner or later, we will have to start testing those. I say for now, with the NASDAQ, we still use the moving averages as levels of support. This area here, 237, which was the previous highs from the start of the year, this now becomes very strong support. This is sort of analogous to that 295 to 300 area in the S&P 500, where the bulls don't want to lose this. As far as the bulls are concerned, the Nasdaq is in a better place now than it was in January, despite whatever we might suspect or think ourselves, right? And until the price actions show something different, we have to assume that that's going to be a level of support. So short term, that's where you want to look at buying the dips on names like Amazon, Tesla, Netflix, Microsoft. If we lose those levels, then we're probably going to come down and test the 50, wherever the 50 period is. And as you can see, there's a gap here that maybe we need to come back and test. But for the moment, I would say the key area to watch is 237. And if we lose 237, probably down here around the low 230s as we test the 50 period moving average. When you have a stock that's or an equity that's trading this strongly or trending this strongly, the moving averages kind of become critical as well, not just the horizontal levels of support. So those are the two areas I'd watch for dips. As you can see, the March 11th levels where we were March 11th with the Qs is way down here, 193. I don't expect this to be tested for quite a while. At the moment, there's just so much extra stuff that's in the way of that if there's going to be an index that doesn't come back and test that level, even if we do end up having a pretty big surge in infections again, it's going to be the Qs. I think this is the one index that probably doesn't need to come back and retest this. So for now, what we want to look at is 237. If we lose that, probably just below it around 230. And then the very major level that maybe it's below that would be down here around 217. But we're probably not going to come and test that in the near future. I think we're going to need some strong or bad news coming in. Maybe something from Fed in the next couple of weeks. Or again, we start to have to impose more travel restrictions or close more businesses down and shut. That would have to, we'd have to have a really big increase in that before we come back and test these areas. Again, as you can see here, this is all pretty bullish, and despite the fact that I suspect we probably need to see more downside soon, the NASDAQ is kind of disagreeing with me and saying, no, we're ready to push upwards. So, one thing to keep in mind, if you're trading to the long side, you're much better off probably looking for dips on these tech names than some of the weaker areas of the market. But what you want to do is just keep an eye out on risk reward. But this is the one area of the market that continues to behave well, and I suspect will continue to behave well even if we start to see the economy slow down even further. All right, now in contrast to that, if we look at the Dow Jones, you'll see a bit of a different chart. Obviously nowhere near all-time highs, and as you can see recently, kind of starting to struggle again. We're already below the 20 and the 200. We're chopping between the 20 and the 50, just like the S&P 500. But as you can see, we're not really making headways towards testing some of these upper levels that we've had before. And if you look at it on the weekly chart, you can see that in this case, we're actually struggling to get back above the range that we spent the last couple of years in. The Dow has several names that have been impacted pretty strongly by our economy being shut down. And obviously, as you can see, it doesn't have that many components either. So those areas that have been hit hard are obviously dragging down the Dow to a certain extent. So at the moment, unlike the S&P 500 that's trying to hold above this level, the Dow's trying to reclaim it, and as you can see, it's failing pretty clearly. So what does that really say? I think more than anything, it just shows where the weak area of the market is. A lot of industrial names are still struggling, despite the fact that their charts are starting to look better. They're still really struggling to reclaim a lot of the ground that we've lost at the start of the year. And that seems to be the case here. You can see the 20s actually starting to curl down a bit. If we look at support levels on the Dow Jones, obviously just like the S&P 500, we just established pretty good short-term support here around 250. It probably come down to 247 and still find some good support because that's kind of a key area. So as long as we hold up there, it just shows again the market that it's just a market that's trading sideways and trying to establish where it wants to go next. But if we lose that level, you can see that the March 11th prices aren't that far away, down here at 233. And that's again going to be a very critical area. And if we end up selling off even further as we head into the middle of July, this is going to become an important area for us to kind of consider and to figure out where we want, what we want to do and where the market wants to go once it tests this level. And I think that it's more likely to come on the Dow Jones than it will on the Nasdaq or the S&P 500. And so this is going to be a critical level for us to watch on the Dow if we do find more selling pressure. Now again, there is always the chance that we've established support here, and as you can see, we did break a nice downtrend, right? So if you look at it from this perspective, we have established, even though we failed at printing new highs, we have established a good floor and are in the process of breaking past that, right? So again, despite the fact that what we're seeing in the news and kind of the feeling we have is that we're probably ready to pull back, in reality, the market is still doing bullish things. We're still kind of establishing support. We're confirming a breakout above a pretty important level. We kind of drifted up into this 246. We broke past it. And even though we failed here at 277, we've come back and reconfirmed support here at 250. So overall, this is still pretty bullish. It's not nearly as negative as maybe it feels. However, we're still dealing with a lot of resistance up here, and we're still going to have to kind of overcome all that before we're ready to really challenge these levels. And I think that's the problem right now I have with going long too strongly, is that we're still, I think, in the process of really sort of defining what our ceiling is. Not really, besides the Nasdaq, I don't think the rest of the indices are really trying to forge to new highs. I think they're just looking for what our ceiling is, and then from there we'll have to establish the bottom of that at some point. But for now, like I said, things are still not that ugly. Now, because this is a difficult market, I still think that anyone that's trading a pattern like this, you probably want to take profits at the half of it and then wait for more profits at the top. There's a decent chance that we struggle to get past the 20 to 200. If we do that and we fail, then we have a failed trend break, which would end up leading to a lower move. So, we're still kind of in no man's land, and I think there's still potential for a move upward or a move down, which again is why it's not really a great idea to trade too aggressively right now. And really what we want to do, and that's one of the things that I like to do in these Wednesday streams, is if there isn't a clear direction, then what we want to do is identify levels where we can get clear directions, right? And so that's what we're trying to do here, is establish where the levels are where we can find support or where we can find resistance, so we understand what we want to do when the market gets to those points. And right now it's in the middle, right? It's not anywhere, it's not really near the support level anymore. It's at a short-term resistance level soon, but the major level of resistance is up here about 10-15 points away. So we want to wait for us. We want to get to these major levels to get more actionable opportunities. We had a much better trading opportunity on Monday than what we do today, because we've bounced for 2 or 3 days now, and we're starting to struggle as we climb higher. But we want to wait for these moments where the market is in a good place to go ahead and take action, rather than trying to take action now when it's in the middle and still trying to figure out where it wants to, if it can make it to the next level. So that's kind of where we stand with the Dow. Major levels, like I said, is this 245 to 250, and then below that 233 or so. And then to the upside, the major level is going to be up here right around 270 to 275. And we'll see what happens from there. Now, the last one we want to look at is IWM. IWM at this point looks a lot like the Dow, right? We've got the same trend break. We've got nice support here. We've done the same thing. We've established that this level is support now, right? We broke through it, and we've established that it's a legitimate breakout. So, again, actually bullish. Despite the fact that it feels negative with the way the market is behaving in the news that we're seeing, the chart itself is actually bullish. And what happens in these cases is a lot of times you'll test up here in the middle point, and then again you'll make it to the top point if the momentum is strong enough. Now, if we falter and we can't make it to the top point, then we're going to come right back down and we're going to retest this breakout around 139 to 137. And again, that's going to be a major level to hold. You can see we kind of have a trend here. that's still holding on IWM. I'm not going to keep that trend line there because I think that trend line was more important for this zone than it is for there. I think at this point we're establishing a new uptrend at some point based off of a breakout confirmation of this, which is what we're doing. So again, despite the fact that it seems relatively speaking weak, and again, if you look at the weekly chart, you compare what we're doing here, we're still below a lot of price action. There's still a lot of overhead resistance. You can see actually over the last 3 days all of the wicks up here compared, as we tried to break past 145. So 145 is actually a very strong level of resistance that we need to clear on IWM. And that's going to be an important area for us to watch, right? So as you can see, we're struggling a bit to get past that. And longer term, that is an important level. If we could break that, that's actually, again, a very bullish move. So IWM actually is a chart that we want to watch a little bit more closely this week than maybe some of the others, because we want to see what happens at this 145 level. I think that's pretty critical. If IWM could get past 145, I think it shows the market does have more buying than maybe we expect, and that there's more legs to this rally than what we're seeing at the moment. So keep an eye on that. I think that's actually a pretty important level to watch. Now, if we lose that level, we come back down, then we're going to have to see what happens here at 136. We lost this 140 area late last week, and we kind of came back down, and we tested the support right away. And I think, again, that's going to be an important area is if we test this support and see what happens. So I think IWM gives us a good test in two different directions. If we could break 145, that's going to be very strong for all of the market indices. And if we head back down, then this is probably the first index that's going to lose support. So this will be our first warning signal. If we lose the 50-pair moving average, if we lose 136, then I think that shows that the market wants to pull back. So, this is probably the index that's going to give us the clear signal as to what kind of, what the health of our market really is at the moment. So keep an eye on it. I think it's going to be important. Again, like the Dow, the March 11th levels aren't that far away. Down here around 123, 124, and that will hopefully be a major level of support if we do roll back down to that level. Now, to the upside, if we break 145, there's a pretty good chance that we make it back into the 150s, which would be very nice because, again, it shows the market is still looking to take risk and is still looking for profits and is still looking for what our ceiling is. And so it would likely lead to a move back through the 200 and up into the previous highs that we printed in early June. So this is probably the index that I think is the most noteworthy as far as checking to see what it does at its current levels. So keep an eye on it, I think, more than the others. All right, so that's the synopsis of what we're seeing in the market right now. I think overall, like I said, we're not in a very easy environment. We're basically just trading sideways. Even on the IWM and the Dow Jones, if you really look at what we're doing here, again, it's the same sort of thing. We're just really trading sideways while we establish what's going to happen now that we kind of rolled over at the top, right? Again, you can see the candles were kind of drifting upwards, and then all of a sudden we just started chopping back and forth. So until we really clear that pattern and start trading in a different direction, we have to assume that basically the market is still just kind of figuring out what it wants to do next. And so despite the fact that I think we have some nice bullish breaks on some of these trends, I'd like to see what it does through that before I really get excited about trading back to the long or the short side. Okay. Let's take a quick look at the U.S. dollar, and we'll look at gold, oil, and silver, and then we'll move on to chart requests. Those of you guys that are in here, if you have a chart request, feel free to type it in. If for whatever reason you can't type it on Twitch, you can always just message it on Twitter, and I'll take a look at it. I know some people maybe don't have an account, or I don't know, can't find the chat bar for some reason. If that's the problem, you can just type it out on Twitter, and I'll look for it there. All right, so UUP, the U.S. dollar. The U.S. dollar, as you can see, is starting to flatten out a bit. It has struggled quite a bit. We didn't meet last week, so we couldn't see what happened last week. But as you can see, it's starting to trade sideways a bit. Let's take a look at how it's behaving versus the euro and the other two crosses that I like to look at, and then we'll figure out what it wants to do. So here's in the euro US dollar chart here, up is good for the euro. And as you can see, it's a pretty bullish chart for the euro, and it's actually not a very good chart for the US dollar. What we're doing here is we're just basically trading a bull flag, and it looks like it's attempting to push past that bull flag and make its way back to highs. So keep an eye on what it does here. Those of you that are looking, I'm not, I don't think there's a lot of forex traders here, but if there is, this 112.7, 8 or 112.8 or so is a pretty important spot. If it can break through that, then it's got a straight shot right back to 113, almost 114. If you falter and fail here, then you've got a straight shot right back down to 112. So, overall, you can see that the euro has gained a lot of strength versus the U.S. dollar, and it looks like it's trying to set up for a move back to the highs. If we look at the U.S. yen, we'll see again, and now in this case, up is good for the U.S. dollar. You can see the U.S. dollar still trying to establish a bottom here. And the yen has shown some weakness and has struggled to gain any ground versus the U.S. dollar. But at this point, they're just kind of both stuck, trying to basically just trading sideways, trying to figure out which one is stronger and which one's weaker. And I think at this point, not really a good trade to see here. We had a nice bounce, but it's kind of coming back, and we'll see what happens with the next level of support here. Overall, not really a lot of trading opportunities here at the moment. And we have the last one we want to look at is the U.S. Canadian. And again, in this case, the U.S. dollar, again, up is good for the U.S. dollar. And as we can see, the U.S. dollar has lost a lot of ground versus the Canadian. Some of this due to oil picking up some strength again, which is one of the major points of economic interest between the two countries. And, the U.S. dollar is trying to stabilize here, find some support at 135. It tried to actually break through, and it failed, and it's coming right back down. And it's looking like it needs to test support again. So overall, really just trying to stabilize and trying to establish an end to this downtrend that really kind of sort of started here in March, and start to stabilize and make its way back up. A lot of this is probably not going to have major moves until our next FOMC meeting. And I think at the moment, again, there's the clearest chart for trade right now would probably be the Euro-US dollar cross, although there might be a bounce coming here soon on the US Canadian. So overall, what we're seeing here is a U.S. dollar that's kind of in flux and kind of struggling to make headways in one direction or the other, which means it's not going to have a lot of influence right now on what oil and gold and silver are doing. And so first, let's take a look at oil. We still have this big candle that we're going to have to deal with. What we could do here is, again, maybe go to a 4-hour chart so we can get the more recent price action. And as you can see, oil is still doing a nice job of stabilizing. It's still trying to break through 40, and it's still struggling at 40, but it hasn't been rejected soundly and started a new downtrend. You can see it came up and tested 40, and then it tried to break out and failed. It came down, but it found support here at the $37 range, and then started making its way back up. And again, it's trying to clear 40 at the moment. I think 40 is a pretty important level, and with news of us maybe slowing down with our economy and with our opening up again, we might see oil struggle to break past 40. So let's see what happens here from 40 to 41. If it falters here, it's likely going to have to come back down and start testing the mid-30s again. If it breaks past it, then it shows that, again, the market is pricing in more of a recovery than maybe what we're seeing in the news right now. So kind of an important area here as it starts to break through 41. And so this is going to be an important price level for us to watch on oil and see what happens next. Now, we look at gold and silver. You'll see that they actually have been performing decently. You can see GLD broke past this range. Then it came back and retested and has started to even continue to break out further. I've started to see some gold miners trade along with this and start to break outwards as well. So it looks like gold is starting to make a strong move here. Today had a nice pullback, and you can see it already bounced. Kind of difficult to try to get in here as it already kind of broke out and has already moved up a bit. But I think overall this is still kind of a bullish pattern as gold tries to leave its previous range and make its way higher. Let's go back to the daily chart so we get a clear picture, and we can see what what's going on here. Now, the one issue I have right now is you don't normally want to buy as it kind of does these upwards trending flags, but I think overall it's actually still not bad, because again, it's establishing 164 as a level of support, and looks like it wants to continue making its way back through that. Let's take a look at silver. Oh. So silver doing something very similar. We can get rid of this trend line. Again, you can see kind of trading in a triangle, and now it's starting to break out. It's struggling to confirm that breakout today, but overall, as long as it holds above the 1670, it will likely continue to push upwards. And so, as you can see, it's starting to try to leave behind, but it's coming into a lot of resistance. I think GLD still, of the two precious metals, I think GLD is still the one that I kind of like a little bit better, especially if you look at it on the longer term chart. You see where it stands right now. You can see there's not really a lot of resistance unless we go all the way down to like a monthly chart. On the monthly chart, you can see there will be resistance coming up in the 170s, right? So about 4 or 5 points away. So, if you're looking at it long term, this is probably not a good spot to get interested in gold long term. Just take a look at what's going on here and what's likely going to happen in the near future. But as a swing trader, I think that there's still potential for another 4 or 5 points at the least as we make our way back up to that level. Now, if we look at SLV on the long term, you'll see that it's still chugging along sideways, and it's still really struggling with a lot of overhead resistance as it tries to it's really still just trying to stabilize. So very big difference between the two at the moment. All right, so that's oil, gold, and silver. And stocks. Those of you that are in here, let me know if you have a chart request. I don't have a lot to look at as far as sharing stocks that we've been looking at recently. So for those of you that have something, I'd love to see what you guys have as far as trades that you're looking at or trades that you are in. This week, what we were looking at as far as trades that I was looking at for my traders is, again, we were looking at that same pattern that we saw on IWM and the Dow Jones, which was a market that kind of established a breakout through a zone and then was coming back and retesting that, right? So, this shows you kind of the idea of how we want to trade this market is you want to do something it's similar to you want to find stocks that are doing something similar to what the market's doing. And so this is one of the ones we were looking at as it had a very clear breakout. Now, unfortunately, today's candle is not the most inspiring as far as confidence is concerned, but we did kind of get to the midpoint of that breakout, and now it's the hope of getting to the top of that zone. But as you can see, there's still this market is still struggling to kind of turn things around. Even though it's technically doing something bullish, it's doing it in a manner that's not really that inspiring at the moment. Because again, there's still a lot of selling pressure coming in here and putting a dent on what we're seeing. There are other areas of the market. Now, again, this is a REIT. I found that REITs in general were exhibiting a very similar pattern. If we look at IYR, it's printing sort of the same pattern, right, where you kind of come down and retest a previous zone and then start to bounce. But generally speaking, still kind of indicative of a market that's range bound, a lot like what we're seeing in the overall markets. Now, the other name we looked at was in the financials. We looked at Fidelity National, but this one again is struggling. It's really struggling to break out of this range. So what we're going to need in this particular case is a market that continues to try to climb upwards, at which point this might come close to making a move. Now, the one thing I do want to point out is you often can't predict whether a trade's going to work in your favor or not. So you always want to make sure that you have the best risk reward possible. And so in these cases, if you notice the trades I was looking at between PEB and this one, you'll notice the risk reward is very skewed in our favor, right? We have a very, very close stop out point, right? Not even, maybe 50, 60 points away. And we have targets upwards of 2 all the way up to 5 points, right? So, you're risking 50 or 60 cents in order to make $2 and $5, right? So even if the trades don't work for you, all you need is one trade to work, and it covers 4 or 5 losing trades. And that's kind of how you want to approach this market right now. Is a lot of your trades may or may not work, but the ones that do work should be able to pay off for the others. And we're not even looking for major extended moves. I'm not looking for a trending stock that makes its way back to all-time highs. We're just looking for a stock that makes its way back towards the middle or the top of its range. And even a trade to the middle is going to give us a good 2 or 3 to reward versus our risk. And that's kind of how you want to structure your trades right now. Is make sure you're trading close to support levels so that you have good risk reward. Even if the trade doesn't work, you know that if it does work, it's going to be able to cover any trades that don't work. Because more likely than not, at this point, if you're getting a 50-50 success rate, you're doing pretty good. And for those that are following me on Patreon, you'll know we actually have a much higher success rate over the last couple of months than 50-50. We're actually probably pretty close to 80% as far as our trades that work versus trades that don't. But what you want to do is make sure that your risk reward is giving you the opportunity to succeed even if your trades fail. Because again, you can't really control what a stock does. The best you can do is control where you're supposed to enter or exit the trade, and make sure that you do it in a manner that's favorable to you, not one that's favorable to the market. Alright, so again, I don't really have much more to share. Anything else that you guys want to look at? I think, I don't know if you're in here, Fat Boys, but I remember you were asking me for some charts last week, and I ended up not being able to look at them. Let me look on my Twitter and see if I could find those for you. Alright, so one of the ones you want to look at was Vail Resorts. Now, interestingly enough, I actually vacated